Hello, my name's Charles Dynastic. I am the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their estate planning and inheritance tax planning. So today's video is around what is an immediate post-death interest trust and how does it help families and specifically save inheritance tax. So welcome back. So what exactly is an immediate post-death interest trust and how will it help my family and how does it save inheritance tax? So an IPDI is a trust that's created on death and qualifies as an interest in possession trust. Now, it can only be created by a will or under the laws of intestacy. So the beneficiary of the trust, the life tenant, has an immediate right to the income generated from the assets held within the trust, or they can enjoy the assets in other ways, potentially living in a residence. So the entitlement may be for the beneficiary's lifetime, and the beneficiary is called the life tenant. However, it could be for a fixed term. It might end when specific circumstances arise, death, remarriage, that kind of thing. Okay, so the trust property in which the IPDI exists belongs to the life tenant for inheritance tax purposes and is treated as part of that person's estate on death. Now, because it's an interest in possession trust, normally when we're dealing with planning, we're gifting 325,000 to a discretionary trust and the remainder of the assets can go to one of these IPDIs. Now, because it's a interspousal transfer, there is no tax on that additional money and there is no limit as to how much can be transferred. So a typical example of such a trust is created by a married couple where one or both have been married before and one or both have had children from a previous relationship, because the IPDI protects the assets for the children of the person who's died. So the will of the first to die creates the IPDI, allowing the surviving spouse, the life tenant, to receive income for life or potentially capital, but not necessarily the right to the actual assets, thus preserving the assets and the capital for the children of the first person to die. Now, after the surviving spouse's death, the trust ceases and the capital and property passes to the first spouse's children, and they are known as the remainder men. They receive the remainder of the assets after the surviving spouse has taken income or whatever. In many cases, clients set this up so the surviving spouse actually gets loans from the trust rather than outright income or gifts, and therefore the surviving spouse's estate pays it back to the first person who dies, and therefore that protects the assets in its entirety for the first person to die children. So this type of trust, as I say, allows the surviving spouse to receive an income or live in a property during their lifetime. However, on their death, the children, as I said, from the previous relationship still receive the inheritance for the parents. That's the important thing. However, in many cases, the surviving spouse may have enough money and they can give up their rights to the trust and make gifts to the children from the previous marriage during lifetime. So this gift can be up to the total value of the trust, thus removing the assets from the surviving spouse's estate, thus saving inheritance tax. Now, another use of the IPDI, which is not well known, is effectively to claim the residential nil rate band of the first person to die. So if the surviving spouse dies with over 2,350,000, they would lose their whole residential nil rate band allowance. So by claiming the residential nil rate band of the first spouse to die, this saves around 40% of 175,000, which is a tax saving of £70,000. Now, both sets of IPDIs, either for protecting the assets for children with previous marriage or for the protecting of the residential nil rate band, must be written in the will as part of good planning in the first place. Okay, because you don't want to rely on deeds variation and things like that, because it ends up costing a lot more money. So it's better to do it during lifetime. So an experienced firm of estate planners and inheritance tax specialists will help ensure that people with high value estates can save significant inheritance tax, but also protect the assets for their families as they desire. So that's the use of an IPDI, very, very useful vehicle, which is not used in an awful lot of planning, but for people with high value estates, very, very useful. Okay, hopefully you found that useful. Thanks for listening. Bye for now. Bye.